Hey guys, and welcome back to the channel. Today we are going to be looking at one of the companies in Philtown's Rule 1 fund, and we're going to look at Sturm, Ruger and Company Corporation, which is a pretty big holding, which is one of the reasons we're going to look at it. But the main reason is that it is a controversial company because they sell weapons. So we're going to look at the financials, see how it is looking, and afterwards we're going to look at the growth rates and the return on invested capital and see if this actually fits Philtown's Rule 1 investment style. So let's start with going to Yahoo Finance and have a look at their financials. So when we look at their Yahoo Finance page with the ticker symbol RGR, we initially see this page, and something that I instantly notice is the market cap. Why the market cap is pretty low, and for a fund of like 66 million, that is actually pretty manageable to have like to invest in like small caps or micro caps. So it's nice to see that he doesn't just stick to the bigger companies and invest what everybody else is investing in. So we're gonna look at a pretty small company and maybe even an unknown company. And second thing I noticed is the PE ratio. PE ratio is pretty high. It is 27.5 is not on the lower side. For a company to invest in weapon, which could be controversial, you actually expect to be trading at a lower multiple. But this could be the case that the earnings are actually been decreasing lately and are at an all-time low, for example, and that is why the PE ratio is looking like this. They pay a dividend. It's a small dividend, it's not that high. So, but if it's a stable company, then there's nothing to complain about from a financial perspective. And looking at the 5-year growth, you see that there was a point where it was trading very, very low, and obviously it could be the case that Phil Town was capitalizing on that, and that he actually invested in this company from this, like in this area, or maybe even around here. Like I don't know at what point he started buying company shares for his Rule 1 fund. But all in all, right now it doesn't look to be attractively priced at all, and it doesn't seem to be in a dip from a share price perspective either. But let's have a look at the financials right now. So starting with the income statement, we see that the revenue has actually been decreasing in the past 3 years, which is kind of a setback to for sure. And the same could be said of the net income. And if you look at the share price, when you see a decrease in revenue, then yeah, the share price should also decrease, and that's what we have seen happen in the past like 3 years. But as of late, it has been increasing again. And I guess if we look at the very short term, and that means like basically this year, then we see an increase again in revenue and net income. So that could be a good sign. So obviously we haven't looked at all the reasons yet, but it could be the case that this decrease and this decrease is actually a temporary setback, and temporary in 3 years. And if you are a long-term investor, then 3 years setbacks is not that long to be capitalizing on a decent company. Looking at the balance sheet, what do we see here? We see it's actually a kind of small balance sheet by the numbers. Only, but we have to see what's actually in it. And here we see that they have a cash position of 165 million, with liabilities of only 64 million, rounded up. So that means that that's the total liability. So their entire cash position can cover their entire debt like almost 3 times. So is this company likely to go bankrupt anytime soon? No. Their cash position has been increasing, while their liabilities have been decreasing, which is a good sign. And yeah, you see stockholders' equity also slowly increasing, but not by a huge amount. So that is looking pretty good. And having a look at the cash flow statement, like in what way does this one differ from their earnings? And here we see that it's actually the free cash flow fluctuates a lot, but recently has been increasing a lot. And if you think of a market cap of 1.2 billion and you have 111 million in free cash flow in the past or the trailing 12 months, then it means that you have a price to free cash flow ratio of about 11. That's actually a pretty good ratio, and compared to the PE ratio, it's a big difference, which is unexpected. But it seems a bit unstable on this part, and but the company itself, like the balance sheet, is looking good. The income statement, like the growth rates, recently don't look good. So what we're gonna have to do is we're gonna have to look at the growth rate of the past 10 years and see how those numbers have been increasing. And yeah, if that is actually looking a little bit better, then we could consider later to look deeper into this company to see, okay, was this indeed a temporary setback, and did Phil Town stick to his own rules? So let's have a look at the growth rate numbers of the past 10 years. And to look at the 10-year growth rate numbers, I tend to use a website called quickfs.net, which is the website or the part of a website we're seeing right now, and then I type in the ticker symbol RGR, and we get to see initially these key statistics. So looking at these key statistics, the valuation ratios seem to be a bit off, like maybe the data is insufficient for that one, so I'm not going to look at that one. But the 10-year growth rate, which you see here, these four numbers are actually available right there, and here you have the return on invested capital. So I believe the Phil Town wants to have at least a return on invested capital above 10%, and they want 10, and he wants 10-year compound annual growth rate of 15% per year over the past 10 years. So looking at these numbers, the return on invested capital, which he finds most important, is being met, his requirement of 10%, and revenue, earnings per share, growth rate, all that doesn't seem to be met right now, but it could be that that's because there's been several setbacks, which we have seen at Financial Yahoo, that we saw like a slow decline over the past 3 years. So maybe that's something we're seeing, and previously it actually had a pretty good growth rate, so we have to look a little bit deeper than just this. On the right you see how the return on invested capital has been moving along, and something to note is that there are a few peak moments, so probably there were high earnings in these 2 years, but overall it tends to be above 10%, so we're looking at a pretty decent company from that perspective. So scrolling a little bit further, we get to see the revenue per year. So this is 2010 and this is 2019. So looking from 2010 to 2019, the growth rate is not that insane. It's actually like 4%, what we just saw. But if you've only looked at these numbers, then the growth rate was actually quite insane. And I think it's pretty decent growth rate from 2010 to 2016 as well. So the company is actually using, or had a pretty good growth rate. But the question is, how did these numbers, why did it start declining from this point onwards? So and here below you can see the revenue growth rate, so that's actually pretty decent. Like nothing to complain about. But overall, this company looks highly cyclical in a very short to mid-term basis, so it is something to keep in mind. And yeah, these growth numbers for a cyclical company or anything remotely close to that don't look that great to me, but I wouldn't be surprised if he was looking at this company from like this time and maybe even a little bit further in years, and then actually thought, okay, well, this growth number is actually pretty decent and it's a stable company. Then bad news, and yeah, share price dropped, and maybe he bought it at a cheap price. Then we have the earnings per share, which actually shows a similar movement, and then all of a sudden you have a drop at the end here. So taking these growth numbers into account, then I could say, okay, initially I would say no, he doesn't stick to his own rules. However, if these growth numbers in the most recent years are actually a temporary setback, and the company can actually show a 15% compound annual growth rate per year normally, then we should see a recovery in revenue to go to like 1,000, so like a billion revenue, and earnings should from this point onward should almost quadruple, or maybe even 6 times or something like that. Should go to about $10 in the next few years. So if that happens, then yeah, his initial screening to see a 15% compound annual growth rate per year could be correct. However, considering this company, I consider that to be unlikely. But nonetheless, this does look like, taking into account what we saw at Finance Yahoo, finance, the return on invested capital is looking good, the balance sheet is looking good, the recent growth numbers, so this year's growth numbers are looking good. So a recovery could be there, and recovery is already visible in the share price. So yeah, it seems like he does stick to his own investment rules for this company, but I think this investment also has shown a risk in this investment thesis, and that is, what if the temporary setback is not that temporary? Because yeah, sure, 3 years is short to mid-term, like for a long-term investor. However, it could be the case that this revenue could steadily decline even further. That has shown in the past a recovery, but obviously the past is no guarantee for the future. So all in all, it was interesting to look at this company. The numbers are not that appealing to me personally. Let me know what you guys think of these numbers in the comments. And yeah, obviously from an ethical point of view, I won't be investing in a company like this regardless of the growth numbers, even though I have a pretty strong opinion about the primary market and secondary market, which is something I may do a separate video about. I still wouldn't want to be associated with a weapon manufacturer personally, but obviously everybody has their own ethical rules and whatnot, so the fact that he invests in it and follow his own investment thesis is actually pretty nice to see. And yeah, I'm curious to find out what his other companies are looking like, and perhaps we'll find a company that is actually worthy of our money right now. Like, he's invested in many financials, and financials right now are still looking to be unattractive investments because of all the money printing. So who knows what we're gonna find out. So if you like this type of video, please leave a like, and yeah, I appreciate any support in the comments as well. For now, I wish you guys a great evening, and I'll make sure to have a video about a financial company that Phil Town is investing in uploaded pretty soon, so stay tuned for that one. So cheers, and see you guys. As always, please keep in mind that I am not a financial advisor. The content on this channel and on my website is intended for educational and entertainment purposes only.